Markets are also backing Bernanke's take on the recovery. Yields on Treasuries rising again. Investors looking for riskier places to put their money. So should you be selling your bonds right now? To help explain, we're joined by Luca Cazzulani, senior fixed income strategist at UniCredit Global Research. Thanks very much indeed for speaking to us. So what has been the reaction in the bond markets? How would you describe that, particularly when we look at the relationship between 10-year and 30-year bonds?
Well, the initial reaction on Friday was of disappointment, and it lasted very short because investors quickly focused on the fact that the Fed has left the door open for more intervention. I think this is very important because now the Fed is somehow stuck not to disappoint market expectations. We had some recovery, immediate recovery in US Treasuries. They are trading fairly stable today. They are probably going to remain at the current levels at least until the next September FOMC meeting, until more evidence is received on what the Fed is going to do. The 10-year has been more affected. The 30-year remains at a relatively steep level. The 10-30 is trading at a relatively steep level, reflecting that in the long run, investors are still very confident that the US economy will exit from the current weak growth environment and will definitely recover. Probably the 10-30 also reflects some increased risk premium given the current situation of the US public debt situation.
So if we look at US Treasuries right now, the sentiment you could perhaps say is that there is fear, but there is also some confidence that US growth will pick up at some point. Is that confidence justified?
Well, investors are trying to take a constructive stance. Bernanke on Friday helped them a great deal in this respect. The short end of the curve is very low. The 2-year is trading just a bit above zero. All the action can happen at the 10-year or longer. The 10-year maturity clearly reflects some confidence that the economy will resume its growth, although at the moderate pace that Bernanke has mentioned.
Luca, do you think, sorry to interrupt you, but I mean, do you think that investors are anticipating more support from the Fed in September?
I think, yes. The way market reacted on Friday clearly suggests that they are still not prepared to go on without a Fed safety net. And the fact that after an initial disappointment, the market bounced back immediately once it was clear that something more might come in September is a clear evidence that markets now are expecting something more in September, or possibly later on if needed, but they are definitely expecting something from the Fed.
What is the catalyst for more stimulus likely to be?
Well, probably the unemployment, which has been pointed out as one of the most relevant variables over the last several months. Growth also, but we are going to get more frequent updates on the unemployment situation. So that's the variable I would look at more closely.
Christine Lagarde used Jackson Hole to express her concerns about the state of the banks right now, saying that they need urgent recapitalisation. From what we know, how fragile are the banks? Could they withstand a sovereign default potentially and weaker growth?
Well, the situation in the Eurozone banking system has been under the spotlight over the last several weeks, and it is clear, as Lagarde pointed out, that there might be an important part of the transmission in case of a contagion. So it's important to take care of that aspect. Clearly, a combination of weak growth and severe escalation in the debt crisis would probably be a problem for the Eurozone banking system, although, as Trichet pointed out over the weekend, the liquidity would be fully provided by the ECB, which continues to provide basically unlimited liquidity to European banks, taking care of their funding, near-term funding position. And this is going to remain the case at least until the end of this year, but I suspect it will be again the case early in 2012 until the situation considerably eases down.
You know, Luca, I want to get a quick one from you on Italy, attempting to raise money this week in the bond market without the safety net of the ECB buying. How much private demand are we likely to see?
Well, I think this week auction is going to go very smoothly. First of all, because the amount on offer is not particularly high, And second, although, as you pointed out, the ECB is not going to buy at the auction, this was never been the case. The ECB is buying in the secondary market. They have bought last week. Today they will show how much support they have given to the bond market. I think it should come about in the 10 billion area. This is going to be a great help for market mood. So I think the auction will probably be no problem. Also, the fact that the market is entering the day with a positive attitude toward the risk is another factor that suggests the auction will go well. And finally, there is a very large redemption coming up supporting this auction. It's about 18 billion of redeeming Italian bonds which will support the auction.
Wonderful to get your thoughts and analysis. Luca Cazzulani, Senior Strategist of Fixed Income at UniCredit. Appreciate your time.